Welcome to the September edition of the E.M.I webinar series. As you are aware from those who have seen the earlier versions, that we cover the global economy, the Indian economy, the stock markets, and your investment allocation across the mutual fund cap curve spectrum in this series. So every month we bring to you the latest update in terms of what's happening in all of these spheres so that we can leave you with a thought process on how you can manage your investments at this particular point in time. So let me start by sharing my webinar presentation to you all, right? As I put this on now, and I trust you can see the page there, right? So let me quickly now move on to the updates on the global economy. As you may remember, the coronavirus crisis led to a multi-pronged massive global response, and we had a three-pronged action from the central bankers and the governments, rate cuts, monetary liquidity pumping, and fiscal stimuli. Right, the rate cuts were of the order of something like 177 basis points spread over the last 18 months and taking the rates to a all-time low of 23 basis points, right? And the second one was the monetary pumping, which was done by the central bankers. So I've highlighted the G4 here, where there was almost a 30% expansion of the balance sheet. The third being the fiscal stimulus by the governments. The US led the way, China and the Europe followed thereafter, directing their efforts towards the supply side of the world economy so that we could experience what was felt was a V-shaped recovery as people came back to work after the crisis was contained. So the expectation of a V-shaped recovery essentially hinged on the methodology used of lockdowns to contain the infection in specific geographies, both in the world and in our country, as you will see in a little bit. So in that sense, the expectation of a V-shape comes also from the fact that hundreds and thousands of scientists all over the world trying to find a cure or a vaccine was expected that in about a year there would be a success, right? So how is the post-COVID world shaping up, right? Lots of green shoots are visible as a result of these coordinative massive efforts, right? Let's talk about the largest economy in the world and the one which drives a lot of other economies, the United States of America. So one of the things in terms of the recent data that we were positively surprised with was that when you take leading retailers like Walmart, Amazon, or Home Depot, and you looked at last year's sales, and then analysts forecast the sales for this year post the lockdown and the recovery mode, and then the actual sales turned out. Inevitably, you're finding that not only did the analysts expect this year to be better after the lockdown was lifted, the actual sales have turned out even better than their expectations. So the world is clearly on a reasonably good wicket in terms of getting back the growth which was prevalent before the crisis and the lockdown. So that's good news. The other good news is that the massive rate cuts and the liquidity have led to a plunging of the mortgage borrowing costs, and unbelievably 30-year fixed rate loans for buying homes are available at below 3%. 2.88 to be precise. This has led to a massive boom in new home sales, the highest since 2007, as well as in second-hand home sales, which are highest since 2006. So clearly the consumer side of the business is coming back on track very quickly, and naturally on a manufacturing side also, you can see that the ISM orders are clearly reflecting a V-shaped recovery on the right-hand side of your graph. And to just put it in context to the earlier recession, which we saw in the global financial crisis, it took almost 2.5 to 3 years for the manufacturing recession to come back to the where it began, whereas this time we have done it in 6 months flat. So clearly the world's response to this crisis has been much better than the global financial crisis, and the results are apparent for everybody to see. And hence the manufacturing PMI, Purchase Manager Index, which is an indicative of short-term GDP growth, because it tells you who's buying how much and compared to last month. You can see the V shape in the PMI very clearly. Point to note is that as it crosses 50, it means that the economy is coming out of recession, right? So now let's look at the broader world economy on a few regions. And if you look at across the Europe and the US, the Apple mobility driving trends are showing a recovery. The same with transit driving trends are also showing a recovery, and global scheduled flights, though not as sharp a recovery as the travel one in the cars, it's also showing a gradual return to normalcy. All right. Other indicators in terms of consumer action are there in restaurant bookings, where you see a growth across various countries. And to look at the Eurozone, which is another big block, you are again seeing a V-shaped recovery in the PMI, and again the PMI reaching a 50 plus level. Let's also look at China. There's a specific reason that we want to look at China, because not only is it proximate to India and it's a big competitor with India, but also the fact that China got the virus first, and also the recovery has happened first. So you can see that both on the consumer demand auto of passenger car sales and the industrial demand of heavy truck sales, you are seeing a V-shaped recovery. There was a slight flattening due to the floods, but again you are seeing the rises back on track. And across a range of indicators, you are seeing varying levels of V-shaped recovery in the Chinese economy. And their PMI, in fact, way back in March itself crossed the 50 and has steadily remained above the 50. So China has clearly taken the lead in the world recovery, and hence the Chinese market is now being viewed as a lead indicator of economic growth in the world, because when China showed a V, a few months later, the US and the EU have also shown the V in their PMIs, right? And so overall in the world, if you take 82% of countries have shown an improving PMI compared with the previous month. So clearly a V-shaped recovery is well on track, which is what this graph demonstrates. The yellow being China, which is the fastest to grow, and the blue being the advanced countries, which will be the slowest to recover, and other emerging countries and the world itself are in the middle. Right? In actual data terms, the IMF's expectation is that from a 4.9% GDP drop this year, they're expecting a 5.4% GDP rise next year. So a delta of almost 10 percentage points. So clearly, a V-shaped recovery is on track on the world. And as I just told you, the recovery in the emerging expected to be 5.9 versus that of the advanced at 4.8 for the year 2021. Right? Another indicator which is indicative of this kind of a move is called the Baltic Dry Index, which tells you about inter-country trade. Right? And there, as you can see, the pre-COVID levels of 1090, the freight rates dropped to 600, but now have since more than doubled. So clearly, inter-country trade is also on the path of a V-shaped recovery. So coming to the impact this has on global markets, right? What we saw was that there's a huge amount of money sitting in cash during the crisis, which moved to the safety of cash. And this money of $3.5 trillion is expected now in the V-shaped recovery to be deployed back in the stock market. And on a median level, you would expect about $2 trillion to hit the equities market, in addition to which the mutual fund and ETF outflows consequent to the crisis have also hit a bottom of -1%. Previous recessions tell you that this is where the turnaround in flows occurs, and we are in the ripe situation for that to happen. And hence, if you see what happened in the crisis time, that the 3-month and 6-month return of safe havens like gold and the US 10-year are reflecting on the flow there, but the 1-month return showing a -5% for gold and a positive 0.11% for the fixed income indicates a reversal of the earlier flows into safety back into risk. A comparison of the 1-year returns at the bottom table will show you that 102 basis points COVID impact on the 10-year fixed income drop in the rates was now being reversed with the 86 basis points rise in interest rates, indicating that money is going out of the safe havens. Gold continued to retain some charm because of the uncertainty around the US elections and all of that. So there is still a little bit of recovery in the 1 year, but as you saw the 1 month, it's shown a 5% drop in prices. So the money back into the equity markets, you're seeing that you have seen all the 3 US indices, the Dow Jones, the NASDAQ, and the S&P are in positive V-shaped recovery mode. And 1 month return, you're seeing the NASDAQ and the S&P 500 has now got slightly negative, because as the US election comes nearer, there is normally volatility around the stock markets. But otherwise, the trend is that post the March drop, you've seen a strong bounce back, NASDAQ leading the way, because tech companies are beneficiaries of this whole COVID and lockdown crisis, right? Now, having completely covered the world economy and the US markets as a harbinger of the rest of the world, let's shift focus to our country, India. And in India, from an economic outlook perspective, it is useful to remember that our slowdown was not linked to the COVID or to the lockdown much before we have been, thanks to the NBFC crisis and the challenges we faced with demonetization and the GST implementation, the negative food inflation. We've been on a downtrend in GDP growth for quite some time now. As you can see from the uh, uh, graph there, all the three components of the GDP or the GVA, as is used to measure it, is services, industry, and agriculture have combined been on a downtrend for a very long period of time. On top of this, there came the crisis, and to the crisis, our response was a severe lockdown. So what the severe lockdown did was two things. One is it was created more success for us on the medical front, but at the same time it hurt us on the economic front. So the government, with that initial success on the medical front, didn't want the economy to get damaged more and had tried to reverse it and to the unlock one, two, three, and now four. Right. So the initial medical success is reflected here in that we managed to contain the crisis, medical crisis, to the urban agglomerations. Though they account for a significant proportion of the GDP, a large part of India's population was initially not affected by the crisis. And the government announced a 21 lakh crore program to tackle the crisis by means of lifeline to cash flow starved businesses, guarantees, increase in the NREGA allocation, as well as much needed credit to the bottom of the pyramid through NABARD and the Kisan credit card. So as a result of this, if you look at the impact of these Atmanirbhar program initiatives, on the right hand side, you can see that it's a partial transmission only of all the government's initiatives, except for the working capital funding for through NABARD for the farmers, where about 83% has been disbursed. So in a sense, the agriculture sector clearly is benefited from this, and you can see the growth terms later, which will show you that they are leading the way. But in the rest of the economy, there's only a partial transmission. So hopefully in the days to come, as this gets completed, you will see a more recovery happening. And the same is true of the RBI's actions, which in addition to an 8 lakh crore liquidity pumping, also led to 115 basis points rate cut. But this rate cut has only been partially transmitted. New loans, the weighted average lending rate is come down only by 23 basis points, and existing loans, it has only come by 23 basis points, whereas new loans, it has come down by 72 basis points. So clearly, there is a lot of room for further rate cuts to happen to boost the economy. So both on the Atmanirbhar package as well as on the rate transmission, there is still room to go to help our economy to recover, right? So as a result of these actions, right, you are seeing here that most world economies, because of the lockdown and the crisis impact, have been on negative GDP growth, barring China, which has been positive. But India is among the worst hit with a 24% GDP negative growth for the last quarter. So this, as I explained, was because we attempted a very severe lockdown, which further hurt demand in addition to the supply crunch that we were facing because of the COVID crisis, right? Now, the breakup of this is given in this table, but I will help you to understand this through graphs, that there are two ways to look at the GDP. The first way to look at a GDP is in terms of consumption and Capex. So there are three aspects to this. There's private consumption, there's government consumption, and then there's capital expenditure, whether it's done by private or the government. So on the private consumption, as you can see, over the last 4-5 quarters itself, it's been fairly at a low single digit level of 5 to 6%, dropped to 2.7% in the last quarter, but in the first quarter of this year, it has collapsed by 27%. So the GDP growth of 24% down is partly accounted by the 26% drop in private sector consumption and by a 47% drop in fixed capital formation. So naturally, when demand is collapsing, nobody feels like putting on fresh capacities, right? And this has been in a downturn for the previous 3 quarters itself in negative GDP growth, but this quarter was a double whammy in terms of a 47%. So personal private consumption as well as fixed capital both have negatively contributed, but the bailout partly was done by the government stepping up on the expenditure. So the government consumption actually has been on double digit growth for the last 4 quarters, and this is what helped ease the pain. But this could have been more, but for some constraint. What is the constraint? You can see that the expenditure blue line has been going up, average around 13 to 14%, But the revenue line, the black line, has been coming down by 7%. So as a result of it, our gap between the revenue and the expenditure, the fiscal deficit, has been shooting up, thereby constraining the arms of the government, because last full year we had a 4.6% fiscal deficit. Just in this quarter, we have already breached 6%. And if the government continues the spending pattern, it will go up even more unless revenues pick up, which is not yet seen, or government is able to do some disinvestment of a big ticket items which can help ease the burden and maybe continue their spending pattern. Otherwise, the rate at which the government is spending, it's likely to remain at the same. Right. Now, I mentioned there are two ways of looking at the GDP. The other way of looking at GDP is which sectors are contributing. So, I have industries, services, and agriculture as the three main sectors. And in gross value added terms, the 24% negative GDP growth was a 23% gross value added growth drop. You can see that industries and services too are equally contributed to the decline, whereas agriculture has been a marginal positive, which is what I would like to explain the means of this graph to tell you that services industry equally have contributed to the drag in the GVA. Agriculture has grown, but again at 3.5% growth, it's a little bit of a not a very strong growth. But I think when the Kharif crop gets harvested, you will definitely see a pickup in agricultural growth in towards the end of the year, right? So now this was the quarter gone past. But as I said, the government and the RBI have done a number of initiatives. They have unlocked it, allowed factories to reopen. So from that perspective, there are certain green shoots available for the Indian economy as well as just like the global economy. So first, the green shoot came in the sense that when the moratorium which was announced by the government for all loans through the RBI, that was coming to an end, a couple of weeks back. So RBI in their policy came up with a framework to give restructuring of capacity to the banks so that borrowers' pain is eased as well as the bank's NPA gets eased. So very significant important step. They set up a Kamath committee. The committee has already submitted its recommendations, and this will hopefully in the coming quarters prove a great relief to both sides, that is the bankers as well as the borrowers. Right? On the recovery side, let's look at the rural side and the urban side differently, because as I mentioned in the rural side for you, initially the success was in preventing it from going to rural India. So naturally, the sowing season, which was the right bang at this time, the Kharif sowing season, was much better than last season. So as you can see here, week on week, the Kharif sowing area as a percentage of normal area sown has been rising, and it has last week it has touched 100%. And as a percentage of normal area compared to the previous years, we are at a 7-year high in terms of the sowing area. So clearly, the agricultural sector has seen some kind of a protection from the impact of the crisis, and hence agriculture, rural Indian demand for vehicles, which is basically two-wheelers and passenger vehicles, has seen that the strong negative growth shown in April YOY has eased up now, and there is an improvement in terms of the sales of two-wheelers and passenger vehicles. But more importantly, tractor sales have actually turned from a negative growth for so many quarters to positive growth. So clearly agriculture is leading the effort of the GDP revival, whatever there is in the country. Right. So along with that, labor also, the NREGA announcement by the government of a 40,000 crore additional has also seen here in terms of a 40% NREGA job demand, which the government has been able to fulfill. Coming to our views on the urban part of the country, right? You can see that various indices on the urban side also show the formation of V. Yes, they are not as sharp, if you noted, as the rural indicators, but yes, there is a sign of recovery happening there. Right? Other urban indicators like traffic congestion are again showing improvement. Television advertising is showing a strong improvement. Freight, if you see cement, steel, coal, fertilizer, the four big bulk commodities, and then overall freight, all are showing varying levels of a V-shaped recovery, as you can see from the graphs therein, right? And certain other indicators like the government purchasing, which is done largely through e-way bills, as you can see, the graph is showing an e-way bill is showing a V-shaped recovery. You're seeing electricity consumption showing a broader V. You're seeing that the unemployment, which has to be an inverted V, because unemployment rises is bad news, so it's the other way. So you can see rural unemployment has come back to the pre-COVID levels. Urban is slightly above hopefully it will come soon. So overall employment, because it's dominated by rural employment, is also roughly at the pre-COVID levels. So if you then look at the unemployment correlated to the business resumption index, right? Jeffrey's leading analysts have created something called an economic activity indicator. And what they are indicating is that we are just shy of the 90% of the pre-COVID levels in terms of the recovery in the business activity. Nomura, another analyst, predicts that we have reached 105% of the pre-lockdown, but we are still way off from the pre-COVID level seen in January, February, March. So overall, we saw the PMI data for the world at large. So India also, we are seeing a V-shaped recovery, but please note that the services sector PMI has reached only a level of 40. So we are still in a kind of a recessionary pressure. Only when this PMI crosses 50 can you say that we have come out of a negative growth period. But the manufacturing PMI has now reached a level of 50 plus. So clearly manufacturing is slightly ahead on the recovery curve compared to services, but both are showing V-shaped recoveries, right? So this strong expectation of V-shaped recovery has been built into the Indian economy now. And this is the way we expect the GDP to pan out in terms of the drop and then the rise. The IMF's expectation for the calendar year is 4.5 negative and possibly a 6 positive negative. So clearly V-shaped recovery is on the anvil in India too. However, in India, there are certain risk factors that we need to keep cognizance of. So first one is that, as I mentioned, initially the success was greater in the rural area. So 80% of the cases for the first 4 months were in urban areas. But in July and in August, the rural share of the cases gone up to 36% and 47%. So much so that as June to August, urban case rise was 3.3x, but rural was more than double at 7.4x. So this rise of the COVID cases in rural India represents three major risks to the economy. The first risk is that the Kharif crops harvesting. So if this spreads a lot and you're going to have lots of people sick, are you going to have a labor shortage for harvesting the Kharif crop when it's due in a few months? Number two, that if a large number of the population is affected by this, then is the rural consumer sentiment going to get affected? Because everybody has somebody in their family affected, he's not going to be in a very optimistic frame to go into purchasing, which was earlier expected that around Diwali, the consumption would again boom. The third thing here is that if these cases do rise, then we may look at reimposing lockdowns at specific states, and that in itself could lead to again a slowdown happening. So keep an eye out for the way the case rise happens in rural India to have a sense of the GDP recovery, right? So the other risk here is that while we saw that two-wheelers, cars, and tractors were jumping up in terms of demand, we find that trucks and buses are still at only 10% of last year average, and three-wheelers at 23%. So long way to go in terms of the general economy, in terms of trading activity to pick up, and a demand for these key components of the economy to pick up, right? The other thing is that when we now look at it from a perspective of the GDP growth, so we saw that 23% was the negative last quarter. Now we are talking about a V-shaped recovery. You can see the V-shape, but the V-shape doesn't mean positivity immediately. All it means is that the next quarter, the current quarter, also we expect a 9% negative GDP growth in India. And the quarter after that, the October, November, December quarter, also we expect a 1.5% GDP negative growth. And only in the last quarter, currently, do we expect a positive GDP growth. So the trend of this recovery, right, is not yet will be reflected in the earnings, because with the negative GDP growth, earnings in the stock market will still be negative. So you have to keep in mind that this trajectory is important to track, right? So now we move our attention to the stock market and the impact of these economic affairs on the stock market. So from a stock market perspective, since we spoke about so many sectors, let's talk about the sectoral performance first, because it's also important, because analysts and fund managers track sectors first and decide on their positive view on sectors and then go and buy stocks within them. So from a sectoral performance, I've catered to about 13 sectors in the Indian economy, sectoral indices rather, and I've taken the safer ones at the top and the cyclical riskier ones at the bottom. As you can see here, The 1 month and the 3 month are by and large in green territory. 6 months to 3 years, there is a mix of green and red. To properly understand this, I've given here the sectoral indices performance from December, March, and September couple of days ago on the 1 year return comparison. So as you can see, March was the worst affected. 1 year returns were uniformly negative. In September, you are seeing a mixed bag. In December was also a mixed bag because Indian economy was already in a slowdown pre the coronavirus crisis. So I've attempted to rank these sectors so that you get a sense of which sectors are doing well, and then we can look at whether that's correlated to their economic performance in terms of the profits and the sales. The last two columns on the right give you the impact of the COVID. That's more historic today. It's a sense of what happened between December and March when the corona crisis hit. So that's more for you to look at and evaluate it. Let's focus on the middle two columns where we're talking about the V-shaped recovery. So there are 13 sectors in all. So I have highlighted the best recovery. One says 1, 2, and 3 in green, and the worst recoveries as 11, 12, and 13. You notice that I'm using the word worst recovery because every sector has shown a recovery of some sort. So the V-shaped recovery, all being in green, tells you that every sector either has got less negative from the March levels or actually has turned positive from the March levels. So let's look at the top three sectors here. They are the healthcare sector, the auto sector, and the metal sector. The worst three sectors are the power sector, the consumer durable sector, and the FMCG sector. So I'll discuss these in detail with the performance of these sectors along with the earnings for the quarter. So let's take the banking sector first. When you look at the banking sector, the 1 month and the 3 month returns are showing positive. The 6 months and 1 year are showing negative. So this tells you that the RBI's moratorium has had the restructuring post the moratorium has had a favorable impact on the banking stock prices, and that's why you're seeing them in green territory. And as you can see, from the down of March to now, the banking sector has shown a 19% recovery in terms of its uh, uh, performance on a 1 year basis, though the 1 year return as of date continues to be negative, right? Now, this recovery, is that borne by the earnings at the ground level? Absolutely. If you look at the bottom left, I've shown the banking sector companies listed in the stock market, how their sales, operating profit, profit after tax, and their margin changes have worked in the recent quarter, that is April, May, June. As you can see, they are all in black, which is an indicator the banks have enjoyed surplus liquidity from RBI. The banks have enjoyed very low cost of funds from RBI, and the banks have not passed on those low cost of funds to the borrower. So they are sitting on good profits, which is what is being clearly reflected in the numbers here. So the return reshaped recovery in the banking is well supported by their earnings in the quarter, and the outlook also with RBI getting into the act now looks better for the banking sector. So our view is that over a period of time, you will see this 1 year return turn to positive as the economy gets into a V-shaped recovery and bankers start deploying this surplus liquidity at good interest rates to fatten their profits. Now, the financial services broader index is not just contains the banks, it also contains the NBFCs, the insurance companies, and the asset management companies in a broader financial space. So that, if you look at the factor, there also the same earnings pattern is reflected in terms of 1 month and 3 month being positive. There, when you look at the quarter one of this year's financial performance, you can see that the large cap and the mid caps have done better, but the small cap and micro cap are suffering. So this is indicative of the fact that the bigger NBFCs are able to raise funding and manage the whole moratorium that they had to extend. The smaller ones are suffering the brunt, both on the liquidity from people to lend to them as well as from the people asking for moratorium. So the correct state of affairs is reflected here. Next, we move to the IT index and IT sector. As you can see, it's all in the green, and it was something that March was negative has turned positive with about a 30% bounce back. And the reason for this, you recollect that in the US stock market, when we discussed it, you saw the NASDAQ was the best performer. So the reason being that clearly the IT sector is a beneficiary of the whole COVID, work from home, the need to have data to manage it, and all of those rationalizing that's happening on the technology front is beneficial for the IT sector, and that's what this bounce back indicates, and the earnings at the bottom of the table at the bottom of the page tells you that the large cap, mid cap, both those IT companies have had widening sales and profit after tax. So those good numbers are also expected to continue in the future. Hence, the stock market is also favorably considering this sector. The next sector is the healthcare sector. The healthcare sector, if you look at it, right, 1 month has been slightly negative, right? But if you look at 3 months, 6 months, and right up to 3 years, it has turned positive. This is another sector where the return, 1 year returns as of March were negative, but today's turned strongly positive. So 58% V-shaped recovery, and that's based on two factors, right? One is you expect increasing business from diagnostics and hospitals in this time of the crisis. Their beds and all will be filled up, and that's what in the table below you can see that by and large the large, mid, and the profits have widened across the spectrum. So the earnings supports this. Plus, the future outlook is also very, very positive for the healthcare sector because as we make progress towards discovering a vaccine or a cure anywhere in the world, if you want to make a large quantity of it, then India's bulk drug manufacturers are expected to come into play, and hence pretty much every company in India may get a bit of the order book. And this positivity is being built in by a stock market buying into that stocks, right? So I think that's the positive news on the healthcare sector clearly reflected here. Now we look at the consumption sector. There are three consumption related indices here. There's a consumer durable sector, then there's the auto sector and the FMCG. Both the consumer durables and auto are rate sensitive sectors. They're all goods largely bought on borrowings, right? From NBFCs, from banks, the like. Whereas the FMCG is low value goods, frequently consumed, fast moving consumer goods. So there, as you can see, the 1 month return in FMCG has turned negative. Why? Because rural India is a big FMCG market, and the cases rising in the rural India has meant that as it is, FMCG companies trade at reasonably high valuations. So market has taken a little bit of a correction and a pause to wait and see how this crisis spreads there. That's why there's a little bit of profit booking that has happened in the FMCG sector. And hence, if you see here, if you go to the 1 year recovery, 1 year return recovery V-shape, you see auto leads the pack, whereas consumer durables and FMCG are much lower. FMCG, I explained. In consumer durables also, the reason is that their biggest season was the summer. We lost the summer due to the lockdown. So now with Diwali also looking a bit of a challenge, maybe the next summer is going to be the trigger for this consumer durable sector. So there's a little bit of, it's not grown as much as the auto sector. The auto sector rise is partially explained by the rise in the two-wheelers and the cars and the tractors, and the fact that their last year was very bad. On a comparison basis, from a negative of 43% 1 year return in March, they are now at 10% positive, right? But do the earnings of these reflect this kind of a positive? Not at all. So if you look at the quarterly earnings in the consumer sector and the auto sector, right across the board, whether it's sales, operating profit or profit after tax or margins, or if there is large cap, mid cap, small cap or micro cap, uniformly they have shown a decrease in their sales and profits. So the current numbers do not justify the rise that's happened. So it's entirely an expectation of a better future, which is driving up the value of these stocks. Next, we look at the riskiest part of the market, the cyclical and the industrial sectors, where again, except for the oil and gas, you're seeing in the 1 month and 3 month market has shown a bounce back. In fact, if you look at the V-shaped recovery, all of these cyclical sectors are still showing 1 year negative returns. But they are much less negative than they were in March. That's why we say the V-shaped recovery is positive, except for the realty sector, which continues to be negative. So the point here that we're trying to make is that the returns are still negative because the situation is still not great, but the market is expecting improvement. And the fact that this situation is not great is clearly reflected in the earnings of the various components of the cyclical sectors like industrial manufacturing, energy, metals, cement, construction. All of their numbers are reflecting red paint all over, which means that they are all badly affected by the lockdown and the corona crisis. Other sectors in the economy, you saw services PMI is yet to fully get past 50. Numbers are reflecting that. Media and entertainment is public awareness. People are not able to go out and watch movies or hotels. Financial services we already discussed. And in telecom, is the positive. Just like IT, telecom is also a beneficiary of the lockdown and the work from home and the consumption of data through watching movies and serials on Netflix and Amazon Prime, and all of that is reflecting in the numbers here. Other sectors are by and large in a negative territory like chemicals, paper, textiles, miscellaneous ones, except for the fertilizer industry, which is reflecting the positivity of the rural kharif sowing. So demand for fertilizer and pesticides has risen, and now all those companies are expressing increasing profits and widening margins, right? To sum up the whole sectoral thing, I'll give you a perspective to how Sundaram Mutual Fund's portfolio allocation is. So we are overweight on these sectors to the extent of 27% of the index. So roughly a quarter of the market in terms of sectoral weightages, we are overweight. The names are given here: IT, pharma, financial services, media and telecom, chemicals and services. The ones where we are neutral are roughly half the market at 44%, private banks, FMCG. So we are waiting and watching, and FMCG is where we changed our view from an overweight last month to a neutral, given the spread of the corona crisis in the rural areas. Otherwise, the rest of this reflects a wait and watch approach, as across our funds, we have a positive weightage in this already, but our becoming view is neutral. That means we stay with what we already have, and we'll make significant changes as we observe. Like you can see below that, in private banks, we have acquired across the board stocks last month, and the same time, we are also done it in a mixed manner in the other sectors. Where are we negative? Where are we underweight? In about quarter of the market, at 28% of the market, in oil and gas, NBFCs, infrastructure, PSU banks, metals, ferrous and non-metals, and real estate. And as you can see, most of those, the one-year returns are negative in line with our view, and across the board, we are also negative in line with our view, right? So that was a sectoral summary of the stock market, and we tried to correlate it with the performance of the economy in those sectors. And as you can see, in some sectors, despite the negative growth, there is a positivity because of the future V-shaped recovery. In others, the bounce back in the market has been supported by the quarterly earnings also turning out to be fairly healthy. So how does this pan out in a market capitalization basis? So here if you see, right, as you can see, all the indices except for a 3-year return are showing positive returns. The other thing to note here, which we will address, is that actually in the bounce back, everything that was negative as of 1-year return of March has now turned positive, but the biggest bounce backs has been in small cap, followed by mid caps, and then by the large caps. So let's try and understand the reasons for this stock market behavior, right? So let's look at the earnings pattern from a cap curve perspective. So the Q4 earnings of last year, which is what the market had when it was starting to invest in April, showed the massive COVID and lockdown impact. So as you can see, the overall market had a negative sales growth, a negative operating profit growth, and a strong negative profit after tax growth of 46%. And if you split it by our large caps, mid cap, and small cap, you can see that small caps were the worst affected, followed by the mid caps, followed by the large caps. How did the new quarter pan out? That is April, May, June, because as they were investing, those numbers were coming out. You can see here that the bad news continued. So the market was down 43%, and with the large cap, mid cap, small cap, we saw the same kind of a heavy drop, reflective of the 23% GDP drop that we experienced in the quarter. Hence, now when you look at the analysis, you will remember the sectoral analysis, right? So the reason I'm pointing out is analyzing large caps, you've got to remember that the performance depends on which of the sectors are overweight in this. So you see 25% is of this is banks, software is another 15%, finance is 10%. So these are the heavyweight sectors whose earnings you should carefully observe. And so when you look at the large cap companies' earnings, which you saw for the sector wise, I have now revamped them by the sector into large caps. You can see it's a mixed bag. So on the left hand side, the heavy weightage, that is larger number of companies, you can see there is some greens and some red, whereas on the smaller share ones, by and large, there's more of red. So this kind of an earnings pattern, whereas in the mid cap and small cap, you see that banks are not the biggest weight, finance is the biggest weight, and there's a different weightage. And if you now look at the earnings, you can see that there are more reds than greens in mid cap in the sectors. In small cap, there are absolutely more reds than greens. And if you go below that to micro cap, which we define as below 3,000 crore market cap, it's pretty much a red scenario. So clearly the sectoral index performance reflects itself into the cap curves performance. Looking at the large cap specifically, large cap indices are up about 27 to 29% from the lows of the March to now. So that factor is because of the earnings of the Nifty specifically being negative. But why has this gone up despite that negative Nifty return is because of FII flows. So if you see the FII flows out from the advanced countries into emerging countries, last year about 3 or 4 countries got positive flows, but this year, the calendar year to date, right, every country except India is negative. Even India was negative in January, February, March at the peak of the crisis. But post the crisis, from April onwards, right, the recovery phase, India is the only country of the emerging countries to have received positive FII flows. So what accounts for this thing? We also parallelly saw a huge negative GDP growth here. So the markets across the emerging countries have all gone up, and India has been ranking wise among the fastest growing market at 34% recovery. The flows in India in rupee terms, right, is 80,000 crores from April to now. So the large cap rise can be attributed to this huge 80,000 crore flow. And why did they come in? Primarily because of a favorable currency outlook. What do I mean by this? Typically, the currency difference between two countries relies on the interest rate differential between two countries. So if you see roughly Indian economy versus American economy, the 10-year interest rates, there's a difference of 5%. The interest rate parity principle indicates the currency has to weaken by 5% to take away any arbitrage by any particular player. So with against a 5% depreciation long-term expected, the crude price drop gave a huge boost to India's currency because 80% of our crude is imported. So demand for dollars was expected to be less, reflecting a positive current account deficit, which brings down India's stability of the rupee improves. Thirdly, RBI also in this period has built up its forex reserves to $500 billion plus. So as a result of which you are now sitting on a pile of forex dollars with which you can defend the currency. So all of this gave confidence to the FIIs, and hence if you see for the last 1 year, rupee has weakened just 2.6%, and in fact over the last 3 months, 6 months, it's shown a positive. So FIIs who invested in India post-April have not only seen a 2.5% currency profit in addition to the profit they saw in the stock market. So it's been a very double positive development. So their expectation and prediction turned out to be right, and that's why FII flows continued to strengthen during the course of the last 4 months. The other reason why money came in is the valuation of India compared to the rest of the world and comparison with our own long-term average. So first is the comparison with the rest of the world. So the dark blue line tells you our PE ratios as a comparison to the world PE ratio, and the green line tells you our PE ratio as a comparison to the emerging market PE ratio. As you can see, sustained level, both these PE ratios have been trading at a premium, right? Which means India has been a favored country. But over the last 6, 8, 12 months, if you saw, those premium line have been dropping. So some months ago, when they looked at it in April, they said India premiums are at a lifetime low, and hence the valuations look very attractive and money came in. So what I've circled in the right hand side, you can see the bounce back in the premium, which means FII money came in and boosted up the market. But the correction in the premium was one of the reasons that FII money came into India. The third is that it's not just the PE ratio. There's also a ratio called price to book value, which indicates the production capacity of the companies in the stock market. That is land, building, plant and machinery. That has also come below the long-term average, indicating that the reversal to the mean will take it back up, and that Indian economy, stock market companies can deliver additional sales without needing to invest in fresh capital expenditure, which means it saves them from interest and depreciation costs. So that's again a valuation positive for India. This is why money came in. And finally, of course, FI is also expecting that V-shaped recovery to reflect in large cap companies. So what does that mean? That the Nifty EPS, which has been showing only about 1.5% growth over the last 4 years at around 450 levels, is expected in the next year, that is financial year 21-22, to jump up to 660. So this V-shaped recovery is being discounted by the FIS today, saying when that recovery happens, Indian economy P ratio will go up. So rather I buy today. Right. So this FII flows explains the large cap rise. But as I told you, the small caps and the mid caps have risen faster. What explains this? Is it domestic MF behavior? Domestic MF flows, if you look at it, actually in the same period that FIS brought in 80,000 crores, MFs sold almost 20,000 crores worth of stocks. So they are not a cause of the rise, right? Further, right? Why have they done this, right? One is the negative outlook on the earnings, which I explained. Fundamental purchases by mutual fund are not supported by the earnings. But more importantly, right? What has happened is that they used up most of their reserve cash when the FII sold in the previous quarter. If you recollect, I showed you that $6 billion they sold, which is about 48,000 crores. Mutual funds stepped in to buy then. Some of it before the fall, some of it during the fall, some of it after the fall, are mixed. But they used up 40,000 crores of their surplus cash in that quarter itself. That's why this quarter didn't have money. Further, in this quarter, if you look at inflows into domestic equities, while gross sale numbers are fairly steady, both in the SIP book and the lump sum book, the redemptions have spiked, which means a lot of older investors who had invested in mutual funds, maybe in 2016-17 period, when they saw a strong rise, and then there's a sharp correction across the market, right, from 2017 to now. So they had experienced a very negative sense in the month of March, and this bounce back has probably led to them kind of saying, I've got my capital back, let me pull out my money and I can re-enter later. So overall, the story for mutual fund inflows is that it's about 7,500 crores negative from April to August. So they didn't get fresh cash to go and buy. Also, the only segment of the industry which got cash was the ETF flows, exchange traded funds, because provident funds and institutional investors largely invest in ETFs. That got about 25,000 crores. But as you can expect, those ETFs are largely large cap ETFs. So that money also has gone into buying only large caps to support the FII buying. So FII has grown in 80,000 crores, domestic US bought 25,000 crores. 1,05,000 crores of money went only into the large cap space. Mutual funds have only sold 20,000 crores worth of stocks, and hence their further inflow breakup, whatever they got also, if you see, because when you say net for the industry is negative, it doesn't mean that every AMC was negative. Some AMCs could have been positive, some negative, but the composition of those flows also was 74% into large cap. So the mutual funds on the hand would not have had much money to buy mid cap and small cap stocks. Further, the earnings background also did not support the purchase. So domestic MF behavior does not explain the sharp rise in mid and small cap. What explains it? What explains it is the new terminology that people use is called Robin Hood investors. These are first time equity investors who are very internet savvy, who are work from home times, have a lot of time on their hand, they have enough cash on their hand to trade, and there are broking houses like Zerodha, 5paise and ICICI Securities and a lot which offer them the convenience of trading, and they get recommendations from these stockbrokers saying these stocks are trading at a lifetime low, 52-week low, good time to buy. So they are in a way gambling into the stock market by going and buying based on these recommendations. The TV channels also add technical analysis saying that this stock is showing this pattern, so from this it should go up. So all this kind of behavior is being used by them more specifically in the mid cap and the smaller cap and even smaller companies. In fact, if you look, they are largely investing in what are called as penny stocks, stocks which trade between 0 to 10 rupees. If you see just a few selection of them, see the price multiplier in just 3 months, 5 to 7 times multiplier. Now, these are not companies fundamentally very strong. That's why they're called penny stocks. Mutual funds obviously don't buy into these stocks, but the fact that these are very low liquid stocks, there are a few shares floating around, means that even a little buying comes and rockets up the price. So these, whether they are hot cakes or hot potatoes, time will tell. But I can tell you that from a fundamental factor, their earnings or anything else does not reflect this. It is more of a rumor-based and a technical-based buying, which has pushed up the prices. And the BSE small cap index, for example, contains 750 stocks. Mutual funds may buy 40 to 50 stocks. So balance 500 are not stuff which a mutual fund buys, but this rally will naturally reflect in that index, and that's what the rise is telling you. So to summarize, right, the stock market is showing a bounce back after the March correction, expecting a V-shaped economic recovery. Second, supported by strong FII flows, by strong ETF flows, and strong retail direct equity inflows. So now that was the past. Let's look at the outlook to decide your investment allocations, the markets, and the cap curve. So immediate earnings outlook, is still weak, right? Because as I said, showed this graph earlier, from a negative 24%, we are going to see a negative 9 and a negative 1.7, and then only a positive. So in the coming weeks and months, you are going to see earnings being challenged in the stock market. So how do you then go about looking at your equity allocation? You've got to understand where we are in the business cycle. Economies go through very good virtuous cycles, very bad vicious cycles. As you all know, right now, with the depressed demand, low capacity utilization, and no capex taking place, we are in the throes of a vicious cycle. So what does this cyclicality tell you? The economic cyclicality leads to cyclicality of the stock markets too. And hence, if you look at it from this table, our economy over the last 16, 17 years has seen four cycles. A virtuous cycle from 2003 to 8, followed by a vicious cycle from 8 to 13, followed by another virtuous cycle from 13 to 17, and then a vicious cycle from 17 to date. So what you can see from these numbers, if you just observe them, is that when the cycle is good, the small caps do better than the mid caps, and the mid caps do better than the large caps. However, the story is very different when the cycle is bad. So you have small caps deeply negative, mid caps less negative, but large caps actually turn flat or positive. So given the whole status of our cycle today, right, this pretty much tells you as to how we should think about your portfolio. Another way to look at it is to analyze the rolling returns of these returns. And that also tells you that large caps, when the maximum returns on good cycles, right, large caps gave you 48% returns per annum, but small cap gave you 70%. So when the going is good, small caps do better. But when the minimum returns, which typically come on bad cycles, large caps have lost on an average about 8%, but mid caps have lost 14% in the worst case, and small caps 21%. And it also reflects in the probability of capital loss over a 3-year period, right? When you have tested 5,000 observations to do this, you can see that the probability of capital loss is far less in large caps and almost 4 times as much in the small caps, right? So given the status of the current cycle and the probability of protecting your capital or losing money as the case may be, right, you got to remember that we also have to factor in that earnings are bad, earnings expectations are good, but in an uncertain future. What will now decide the whole thing is what is likely to be the demand for stocks, which also plays a part in returns. And for the demands, let's look at FII flows. How are they going to continue to sustain in the future? And there you got to look at that. There are FIIs who come for the short term, but there are FIIs who come for the long term. And they invest based on India's positive long-term outlook. But their investment today or over the next few months will give you returns in the stock market today. From that perspective, India's long-term economic outlook has a very strong positive bias because of the strong structural advantages vis-a-vis China. In that perspective, if you now look at the labor population of India and China, China's is a declining labor, India's is a rising labor for the next 30 years. In fact, the quantum of difference is stark of 21 million losses, whereas 115 million is the addition to working age in India. The skill levels of India also support across a range of skill levels. We have adequate workforce. The per capita income of China is 5 times that of India, so our labor force is 5 times cheaper than China. The COVID crisis has given a further boost to people wanting to move out of China. 44% of people say their intention to relocate out of China has increased because of this, and about roughly $500 billion is China's export, which is at stake. China itself may shift something to Vietnam, about 140 billion. India can get about 70 billion as things stand, but the government's steps in terms of attracting foreign direct investment As you know, India has been a darling of foreigners for FDI also, as this table shows you. So we have been rising to about 3.3% of world FDI flows, but we need to strengthen this, and the government is very proactive and sensitive to this. They've cut the tax rates to half from 35 to 17. They have also removed dividend distribution tax for FDI investments, so their profitability improves. The infrastructure, GST reforms, and all of that action the government has taken has helped improve India's ease of doing business ranking strongly, and hence India is now among the most attractive countries globally from a financial attractiveness, people skills and ability, and a business environment perspective. So this basis now has been further strengthened because the government has started doing a lot of actions on other factors which drive relocation decisions, and hence with a vision on infrastructure of spending 100 lakh crores over the medium term and introducing a lot of reforms during the Atmanirbhar program itself. The government announced a number of reforms which all feature in the most difficult but high impact reforms on the top left quadrant in this graph have been pushed through by the government at this point in time, right? Specific action on the electronics gives you a support to government sensitivity because the drop in electronic exports because of the corona crisis, the government immediately launched a plan, $7 billion plan, whereby they offered 4 to 6% in sales production linked incentive to companies who come to manufacture in India, and they had a window till 31st July for people to apply. 22 foreign companies, suppliers of Samsung and Apple, which accounts for 60% of the world mobile phone market, have made that decision to relocate to India. This is likely to lead to a 11 lakh crore increase in mobile device and component production and about 12 lakh jobs being created, right? So as a result of this milieu, India is going to be that country. If you see 1990 to 2008, the 16-year period, so China make the big leap from number 10 to number 3. And in the next 16 years, from 2008 to 24, right, China is going to take that third position to the top position. But the surprise factor here, the dark horse, is India, which neither in 92 nor in 2008 was anywhere in the top 10. India is going to straight away make a leap into the third rank. So by 2024, India is expected to be the third largest economy in the world. This is the long-term positive outlook on backed on which FDI will come in and FII flows will come in. So FII flows are likely to remain favorable due to this outlook. But there should be money availability, right? Liquidity. And you already saw, right? There's $3.5 trillion sitting in cash, and there's a 2 trillion of which we expect to head towards equities. So a portion will definitely come to India. But in addition, the global monetary stimulus is likely to continue because over the period of the next year, around $13 trillion of liquidity, monetary stimulus is expected to be pumped into the world economy by central bankers of just the G4 countries. So ample liquidity is expected to be available for the large cap space, and also that you look at it, the domestic MFAM also has a bias towards large caps because of the 10 lakh crore of the industry, pure 31% is in large cap funds. But even within the rest, if you look at multi-cap and hybrid, if you look at the breakout, almost 68% of domestic MFAUM is in large cap stocks. So there is adequate liquidity available that if FIs sell at particular points in time, mutual funds will step in to buy. Hence, liquidity support for large caps is expected to continue strong even through this vicious business cycle that we are currently in. And from a valuation perspective also, if you look at it, yes, the market looks reasonably valued. But if you take away the top 10 stocks, as many of you are aware, this particular rally has been a polarized rally with top 10 stocks dominating. So if you take the valuation of the Nifty and then compare it by removing the top 10, you can clearly say that valuations are very, very reasonable. This is called a TTM chart, that is trailing 12 months PE. The next one is the forward PE for next year. As you can clearly see, the broader large cap index is not overvalued. It's just these 10 stocks which are the darlings of the FIIs, which have been taking up the overall Nifty valuations. And if you take a broader based approach, that as Indian economy begins to enter a V-shaped recovery, you will see all these companies also begin to benefit. And hence from a valuation perspective also, both domestic mutual funds as well as FIIs are likely to continue to invest in the large cap space, right? So the valuations I spoke about, so you're looking at a forward 22 valuation of 16 and a half, but if you take away those top 10 stocks, this is probably likely to head to 15, and hence mid caps and small cap are trading at about 14. But the underlying assumption behind this valuation is about a 24% growth in the Nifty's EPS and a 23 to 20% growth in mid and small cap. So arguably, given the strength of large cap companies, the reliability of the 24% is pretty much, okay if a V-shaped recovery happens, but on mid cap and small cap, you will have to give them a bit of time. So whether this 23% now that the market is expecting really turns out, we will have to wait and see. In the context of that, the equity asset allocation strategies, first thing for you to remember is that you should take your risk profile into account. So if you call yourself an aggressive investor, the willingness to accept losses for significant periods of time in the search for long-term wealth creation, even then, at this point, you should have a 5-year horizon and you should have a flexibility in your approach. That means that today, as an aggressive investor, you still should put 50% in large caps and the balance in mid and small. Maybe a year later, as you see the V-shaped recovery in the economy panning out, you can then shift down the large cap allocation and increase your mid and small cap. If you're a moderate risk reward, which explains most of the market, I would suggest that you put 70% into large caps and 30% to mid and small. Maybe a year later, you can take the aggressive positioning of today in your portfolio. If you're a conservative investor, then don't touch small caps right now. Stick to large caps at 80% and a little bit 20% of the larger mid caps should be the key. So essentially for the next 1 year at least, your portfolio should have a bias towards large caps. And to close out my argument is that though large caps give lesser returns in good economic cycles than mid and small caps, the fact is that if you stick for a long-term investing, like a 15-year, 20-year period, they have still delivered you healthy double-digit 11% per annum returns, which in comparison, let's say bank deposits, because these are taxed only at 10% taxation, long-term capital gains, post-tax you still get 10%, whereas in bank deposits at 6 to 7% and taking away 30% in taxation, you are down to below 5. So effectively, even the large cap space with lesser risk, greater stability is able to offer you double the post-tax return of alternative bank deposits. So that's why at this point in time, the large caps look to be an attractive space to do your investment allocation. At this point in time, the amount will depend on the risk profile as we just discussed. Thank you very, very much and happy investing to all of you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.